Welcome to the FinGlimpse podcast, where we analyze the world of business, finance, and the economy. We cover the latest market news, economic trends, and some interesting businesses. As a standard disclaimer, this podcast is for informational purposes only and should not be considered investment advice. Always do your own research. Now, let's get started.
Welcome to the Deep Dive, the show where we cut through the noise and get straight to the most important insights. Today, we're taking a close look at a really critical and frankly dynamic sector, India's affordable housing finance.
Yeah, and we're digging into a detailed research report here. It's from Asian Markets Securities Private Limited, dated March 25, 2025. It gives a really powerful lens on how companies are navigating this whole space, sort of a shortcut to getting up to speed.
Exactly. So our mission today is to unpack the business case. Why is affordable housing such a big deal in India? We want to understand the unique strategies setting the top players apart, thinking about companies like Aadhar Housing, India Shelter, Aavas Financiers, Home First Finance. You'll walk away with, hopefully, a clear picture of what makes this market tick, its growth drivers, and some of the surprising challenges, too. Let's jump right in.
Okay, so maybe let's start with the basics. What is affordable housing in this context? Well, as per the RBI guidelines, it specifically means home loans with a ticket size under Rs 2.5 million. And over the last, say, 5 to 7 years, this sector has really emerged. It's become a strong business opportunity that's mainly driven by solid growth, pretty attractive risk-adjusted returns, and importantly, well-managed asset quality.
Okay, a strong start, like you said.
Mhm.
But if we look at the bigger picture, how has credit for affordable housing done compared to other loan segments?
It's an interesting contrast, actually. Outstanding credit for affordable housing, those loans under 2.5 million, it grew at about a 5.9% compound annual growth rate, or CAGR, from FY19 to FY24. But, and this is key, that growth was actually slower than the mass market segment. That's loans between Rs 2.5 and 5.0 million. They grew at 15.8% CAGR. And prime housing, so loans above 5.0 million, well, they surged at 20.1% CAGR.
Right. So even though it's a compelling opportunity, the overall outstanding credit didn't grow as fast for the smaller loans. But then you've mentioned specific companies were outperforming. What does that tell us? Where's the real action happening?
Exactly. That highlights something crucial. While the bigger loan segments naturally have more outstanding credit overall, these nimbler, affordable housing finance companies, the AHFCS, they are laser-focused on new loans in this underserved affordable segment. So disbursements for affordable housing grew slower overall, about 12% CAGR. Public sector banks were even slower, just 6%. But HFCs and NBFCs, much stronger disbursement growth, 15% and 36% CAGR respectively. And if you look at a specific sample of 5 listed AHFCs, they really blew past that. We're talking 19.5% disbursement CAGR and 23.6% AUM CAGR over that same FY 1924 period. This isn't just growth for growth's sake. They're actively building market share where the big players are slower. It's fundamentally changing the game.
Yeah, that's a great insight, a strategic focus. And that brings us to where they're focusing. Is geography a big part of their strategy too?
Oh, absolutely. A key trend is these AHFCs increasingly targeting semi-urban and rural areas. Those regions are actually growing much faster, I think 17% and 16% CAGRs, compared to just 12% in urban centers. And it's not by accident. It's strategic. There's often less competition and sometimes better asset quality in these markets. We're seeing really strong growth in states like Rajasthan, Bihar, Gujarat, Telangana, Andhra Pradesh, places like that.
Okay, so we've got the big picture, but let's get into the details now. What's the secret sauce? What really sets the winners apart here? The report mentions this Composite Index Framework, evaluating companies across 14 different things. What are the really key factors?
Well, one critical piece is getting a broad geographic footprint, but also deep market penetration. That helps reduce competitive pressure. So for instance, India Shelter and Aavas Financiers, they operate over 45% of their branches way out in Tier 3 cities and even smaller towns, really getting deep. Compare that to Home First Finance, they're at about 23% in those areas, and Aadhar Housing Finance is around 41%. But what makes Aadhar stand out, really, is its diversification. No single state is more than 14% of its assets under management, its AUM, and its top 3 states only make up about 40%. That's way lower concentration risk compared to Aavas at 67%, India Shelter 61%, Home First 59%. That spread gives them resilience.
Okay, that diversification point is interesting. Now, here's something that feels a bit counterintuitive. Why is a smaller loan size often better in this market? You'd think bigger loans equal bigger profits, right?
It's a great question, and it really gets to the heart of this market's dynamics. Companies focusing on loans averaging, say, RS 1.5 million or less actually face less competition. Why? Because it takes a lot more operational effort sourcing, underwriting, managing these small loans. It just deters the big players who focus on lower margins and higher volumes. Look at the numbers. India Shelter has 76% of its AUM in the small ticket segment. Aadhar 65%, Aavas 60%, Home First 56%. But then you look at someone like PNB Housing Finance, only 41% of their AUM is below that 1.5 million mark. So that focus on smaller loans creates kind of defensive moat, makes it harder for others to just come in and compete purely on scale.
That makes perfect sense. So it's about specialization in a high-touch segment. What about dealing with self-employed customers? That can be tricky, right? And how do they actually get customers?
Right. Assessing income for self-employed borrowers is definitely challenging. And companies that master this combine with strong internal sourcing. That's a big edge. India Shelter, for example, 72% of their FY24 AUM was from self-employed individuals. Aavas was at 60%. They clearly lead there. And on the sourcing side, companies that rely heavily on their own teams, their in-house models, tend to get better growth and more stable margins. They control the quality more. India Shelter sources an incredible 98% internally. Aavas is at 85%. That contrasts with Aadhar, which uses a mix about 34% internal, but also direct sales agents and their network of Aadhar Mitras. And Home First relies a lot on external connectors.
Okay, and how does all that internal stuff, operations, technology, how does that feed into success? Does it make them more efficient?
Operational finesse is absolutely crucial. Companies that have separate teams, distinct verticals for sourcing, underwriting, operations, collections, they minimize overlaps, and that tends to lead to better asset quality. Aavas, for instance, has this remarkably low 3-year average credit cost, just 16 basis points. I mean, think about that. For every 100 rupees lent, they're losing less than 2 pays to bad debt. That's incredibly efficient risk management.
16 basis points. That's
Right.
wow. That's astonishingly low. So how is technology making a real difference on the ground for these companies?
Oh, tech investments are huge. They're driving productivity and helping with compliance. India Shelter, for instance, they have an industry-leading turnaround time TAD of just 5 to 6 days. That's from loan application logged in to money dispersed. Super fast. Avas was slower, but they've really invested. They cut their TAT from 13 days down to 8. Their IT spend went from about 4% to over 14% of expenses in that time. Alvar's also invested heavily, around 15% of its other expenses on tech recently. They've upgraded to the cloud, built robust systems for analytics, fraud prevention, you name it. It's all about optimizing every single step.
That's a huge speed advantage. Okay, finally in this section, the report mentions non-housing loans or NHLs. What's the strategy there?
Right, so RBI rules say HFCs need at least 60% of their assets in housing. That leaves up to 40% for other stuff, mostly loan against property or LAP. And the interesting thing is these NHLs usually offer better risk-adjusted yields, typically 150, 200 basis points higher than standard home loans. Companies are playing this differently. India's Shelter is already near the limit at 42% NHL. Aavas is at 31%, Aadhar 26%, Home First only 15%. So while India's Shelter has kind of maxed out that NHL potential, Home First and Aadhar have significant room to grow their NHL books that can really help boost their overall yields and growth, balancing out the housing portfolio.
Got it. So we've looked at what makes these AHFCs tick. Now let's zoom back out. What are the big forces driving this whole market forward? And then maybe what are the storm clouds, the major risks? Let's start with the tailwinds first.
Well, the single biggest driver, honestly, is just how low mortgage penetration still is in India. Our mortgage to GDP ratio is hovering around 9.4%. Compare that globally, the US is at 60%, the UK 64%. It's drastically lower. That signals just massive untapped potential. The projection is it could reach 14-15% by FY25. Even within India, you see big differences. Chandigarh is already at 41%, Maharashtra, Telangana around 32%. Shows you the room for growth everywhere else.
And it's not just about penetration rates, right? The sheer need for housing in India is immense.
It's truly staggering. The projected housing deficit hit about 100 million units by 2022. And that deficit mainly hits the lower income and economically weaker sections, exactly the target market for affordable housing. This huge gap translates into an estimated incremental housing loan demand of, get this, RS 50 to 60 trillion. It's just a monumental market need, driven by urbanization, population growth.
Government support has also been a big factor historically. What's happening on that front? Anything new?
Yeah, the upcoming PMAYU 2.0 Pradhan Mantri Awas Yojana Urban that's set to launch in September 2024. It looks like a bit of a game changer. Its intra-subsidy scheme targets EWS, LIG, and MIG segments, that's economically weaker section, low-income group, middle-income group. Max subsidy is Rs 0.18 million. But here's the crucial difference from the older scheme. The subsidy is spread out over 5 years, and the loan account has to stay active to get it all. That directly helps the lenders. It reduces the risk of people paying off early or transferring their balance elsewhere, makes for more stable loan books. Plus, we're also seeing a rebound in loan sanctions under the rural scheme PMA Grameen in FY25.
That's a clever tweak to keep loans sticky. What about affordability for the average person and the growing middle class?
That's another key driver. The Knight Frank Affordability Index, which basically looks at the EMI to income ratio it shows affordability, has actually improved in top Indian cities recently. That's despite interest rate hikes, mainly because incomes have been growing steadily. Mumbai, for example, affordability improved from 67% back in 2019 down to 50% in 2024. And if you connect that to the bigger demographic picture, India's middle class and aspirers are projected to grow from about 81.7% of the population in 2021 to 84% by 2031. That rising income level creates a really strong structural growth opportunity for affordable housing. More people can simply afford to buy a home.
And how much does the overall interest rate environment matter? How sensitive is this market?
Oh, very sensitive, especially at the affordable end where customers are really watching every rupee. Even, say, 50 basis point cut in the RBI's repo rate could reduce EMIs by about 2.5%. That might not sound like a lot, but it can significantly boost demand. It frees up disposable income, makes that home purchase just a bit more achievable.
Okay, those are some powerful forces pushing things forward. But like you said, every market has risks. What are the main challenges these companies face?
The number one risk, increasingly, is competition. It's really intensifying. Post-COVID, we've seen banks, larger HFCs, small finance banks, other NBFCs, they're all looking for yield, and they're expanding into secured loans, including affordable housing. Take PNB Housing Finance. They've set this aggressive target, Rs 150 billion AUM in affordable housing by FY 26-27. And crucially, their incremental yields are often 100 to 300 basis points lower than the specialized AHFCs. That tells you they're willing to compete hard on price, putting pressure on everyone else's margins.
Right, competition for customers. What about competition for funding? Are there challenges there for these specialist lenders?
Yes, that's a really important point. Most of these AHFCs have credit ratings of A stable or lower. That means they often can't access funding as cheaply as the larger HFCs or banks with higher ratings. They tend to rely heavily on banks and the National Housing Bank for their borrowing. This leads to higher borrowing costs and makes them more vulnerable if interest rates go up. It directly impacts their bottom line.
Okay, so funding access is a hurdle. What about the actual houses? Is the supply of affordable homes keeping up with all that demand you mentioned?
Unfortunately, no, not even close. There's a major demand-supply gap. In the top 8 cities alone, the annual demand is around zero point 0.6 million units. The supply, only about zero point 0.2 million. And for the EWS ILIG segment, the core affordable market, it's even starker. Demand is around 0.34 million units, but supply is a mere 44,000. Why? Well, it's a mix of things. High land costs, outdated building rules, really slow project approval processes. It creates a real bottleneck.
That's a fundamental constraint. Any other risks, maybe related to who owns these companies? You mentioned private equity earlier.
Yeah, that's an interesting one. Some AHFCs have a high level of private equity ownership. Aavas, for example, 75%, Aadhar 64%. Now, this can pose a short-term risk called stock market overhang. Basically, the market anticipates that these PE investors might sell large chunks of shares eventually to exit their investment. That potential future selling pressure can weigh on the stock price in the near term.
Okay, a market sentiment risk. And lastly, something very practical, people. Employee turnover. Is that a big issue?
It really is for some. High attrition rates, we saw figures like Aavas at 51.8%, India Shelter 42% in FY24. That creates real operational headaches. It impacts customer service consistency, collection efforts suffer, you lose valuable institutional knowledge, plus it just costs a lot to constantly recruit and train new people.
Right. Now, we also got some fantastic insights from Andromeda, India's largest DSA direct sales agent, really getting the pulse from the ground level. What did they tell you about current home loan demand? Is it strong?
Their feedback was quite telling, actually. They said home loan demand right now is a bit lower than expected. They put it down mainly to two things. A bit of a slowdown in real estate sales since last October, and also customers finding it harder to pull together the initial down payment.
Okay. And how are the traditional banks reacting in this competitive space?
They mentioned the nationalized banks, think SBI, Bank of India, Central Bank, are getting much more aggressive. They're competing harder, offering cheaper home loan products, and that's allowing them to grab a bigger slice of the market, putting more pressure on the AHFCs.
Interesting. What about balance transfers? People moving existing loans. Is that a focus area?
Yes, definitely.
Yeah.
Lenders, both public and private banks, even NBFCs, are really focusing on balance transfer or BT cases. It makes sense strategically. These customers already have a proven credit history, so they're seen as lower risk. Apparently, nationalized banks are even paying higher commissions to DSAs like Andromeda to bring in these BT cases.
So if everyone's chasing these customers, what about speed? Turnaround time is crucial. Who's winning there, according to Andromeda?
The public sector banks, surprisingly perhaps, they seem to have the edge right now. Andromeda reported PSBs can give an in-principle loan sanction in about 3 hours and actually disperse the money in just 3 working days. That's faster than private banks and NBFCs, which might take 4 to 5 working days just for the initial sanction, plus another day or two for dispersal. That speed is a real advantage.
Wow, PSBs stepping up. And finally, what about the loan against property, the LAP segment? Still attractive.
Very much so. Private banks and NBFCs are quite aggressive there. The yields are better, remember, typically 50 to 100 basis points higher than home loans. And importantly, they noted that lenders are keeping a close eye on how that LAP money is used, so intentional defaults seem to be quite low, which is positive.
That's incredibly useful context from the front lines. Okay, let's zoom in now on one specific player the report highlights.
Yep.
Aadhar Housing Finance. How do they kind of embody some of these winning strategies we've talked about?
Right, Aadhar. They're positioned as India's largest affordable housing finance company and also the most geographically diversified. As of December 2024, their AUM was Rs 240 billion. That's grown at a solid 16% CAGR since FY19. But what's really impressive, I think, is their resilience. They've managed to weather sector challenges without major hits to their asset quality. That really speaks volumes about their model.
So how do they achieve that wide reach and that diversification you mentioned earlier?
Well, they have this massive network, 557 branches across 21 states and union territories. And they use this clever graded expansion strategy. They have different types of branches: deep impact, ultra micro, micro small main. This lets them test new markets carefully, expand efficiently, optimize costs. And crucially, as we noted, no single state is over 15% of their AUM. Minimizes that concentration risk significantly.
And their typical customer, the loan profile.
They really stick to their knitting low-ticket loans, averaging around Rs 1 million. And they're conservative on loan-to-value, around 59%. A good chunk of their book, 56% as of the third quarter FY25, is salaried customers, generally seen as lower risk. And importantly, 68% of their customers are in that EWS-led category, the core affordable segment. Their non-housing loan book, around 25.9%, also gives them that room for growth and yield protection we discussed.
Okay, diversified base, focused loans. What about how they actually find these customers, their sourcing strategy?
It's genuinely multi-layered. They use their own direct sales team, sure, but they also have this huge network of over 12,600 Aadhar Mitras. These are basically local connectors, people deeply embedded in their communities who can identify potential borrowers. It's quite unique. On top of that, they use traditional DSAs and digital channels too. It's a really flexible, scalable approach to customer acquisition, adapts well to different markets.
You mentioned tech earlier being key for the sector. How has Aadhar specifically used tech?
They made a big move partnering with Tata Consultancy Services, TCS, for an integrated lending and securitization platform. That went live back in October 2021, and it's delivered results. Their approval to login rate is up to 75%. Dispersal to login is around 47–48%. Big efficiency gains. They also use data science quite extensively for risk-based pricing, figuring out the best branch locations, even customer retention strategies. Their tech cost works out to about Rs 1,200 per loan dispersed. That shows not just investment, but pretty efficient deployment of that tech spend.
That's impressive efficiency. So pulling it all together, how does this translate into managing risk, especially through tough times like the pandemic?
It results in what the report calls a credit-resilient model. Even during COVID, their average credit cost was only 53 basis points, despite their large size. That's strong. A key part is their hybrid underwriting. It's centralized and faster for salaried customers. But for the trickier self-employed segment, it's decentralized, done more at the branch level for a deeper assessment. This balance seems to work. Their 2-year lag gross non-performing asset ratio was just 1.5% in FY24. And they have high provision coverage, 41% on stage 3 assets. It points to a conservative, effective risk approach.
So looking forward, what do the financials look like for Aadhar? What's the growth projection?
The outlook is pretty robust, according to the report. They're projecting a 20% AUM CAGR through FY27, net interest income CAGR around 21%, and profit after tax PGR also around 20% over that FY24-27 period. And they expect to maintain strong returns, return on assets hitting 4.2%, return on equity at 16.0% by FY27. What really underpins all this is their funding advantage. They have the lowest cost of funds among the AHFCs thanks to that strong acostable credit rating. That's a massive advantage in the lending business. It points to a really sustainable model.
Okay. So we've covered a lot of ground today. We've navigated this complex but definitely opportunity-rich landscape of India's affordable housing finance. You've seen how strategic choices where you operate, the loan size you focus on, how you source customers, how you use tech, how all that can create a real winning edge. And we've also touched on the critical role of government support in this whole picture.
Yeah, and we've also looked at the headwinds, right? The intensifying competition, the funding challenges for some, those persistent supply shortages, even the kind of niche risks like PE exits and employee churn. It's clear that while the potential is absolutely enormous, the path forward isn't without its hurdles.
Absolutely. So as this sector keeps evolving, driven by those huge housing needs, but also facing that fierce competition, what stands out to you as maybe the single most critical factor, the one thing these companies absolutely need to nail to keep growing and effectively serve this vast, underserved, affordable housing market in India? What's the key takeaway for you?
That's all for this episode of the FinGlimpse podcast. If you found our discussion insightful, please consider subscribing and leaving a review. We'd love to hear your thoughts and suggestions for future topics. Until next time, stay informed and make smart decisions. Goodbye.